Welcome back to Skytech-Lens across Africa. A quiet but powerful change is underway. For years, the African Growth and Opportunity Act gave African nations special access to the U.S. market, fueling jobs and factories. But new U.S. tariffs have upended this, pushing African economies toward China. As U.S. doors closed, China seized the opportunity, offering loans, building infrastructure, and signing trade deals. This shift is more than economic, it's geopolitical. Africa now stands at the center of a global power shift. In late 2023, the U.S. imposed new tariffs on African goods, ending years of duty-free trade under AGOA. Tariffs rose sharply, up to 22%, making American markets nearly unreachable for African exporters. U.S. retailers turned to Asia and Central America, leaving African partners behind. As America closed its doors, China stepped in, reshaping Africa's global alliances. The numbers tell the story. Between mid-2024 and mid-2025, U.S. imports from Africa dropped 28% in value and 22% in volume. American buyers weren't just paying more, they were buying less. The pain was felt most by African producers who lost their biggest customer. Meanwhile, China's trade with Africa soared. Imports of processed African goods rose 18% in volume and 31% in value. China wasn't just buying raw materials, it was snapping up higher-value products, the very ones AGOA had encouraged. In Kenya, textile exports to the U.S. fell 29%, causing job losses and currency depreciation. Tanzania's gold-copper exports to the U.S. dropped 38%. Ethiopia's coffee faced new barriers. Each statistic is a story of lost opportunity. China stepped in, buying what the U.S. no longer would, and investing in Africa's capacity to produce more. The result? A direct substitution effect, with China replacing the U.S. as Africa's key trading partner. African nations facing lost revenue had little choice but to pivot east. The data chronicles not just economic shifts but a major geopolitical realignment. Tariffs didn't just change trade, they changed the world order. China's response went far beyond buying more African goods. Beijing launched a wave of strategic investments, funneling $7.8 billion in new loans into Africa in early 2025. Metallurgy, textiles, electronics, food processing, and logistics were the main targets, sectors that feed China's own supply chains. In Kenya, a $1.2 billion loan built a manufacturing park focused on textiles and processed foods, rescuing industries hurt by U.S. tariffs. In Egypt, a $600 million industrial complex began producing electronics components for Chinese markets. These projects weren't just loans, they were lifelines, integrating African producers into China's economic orbit. China also upgraded Africa's logistics railways like Djibouti-Addis Ababa and Mombasa-Naivasha became vital arteries for moving goods to Chinese ports. The strategy: build Africa's capacity to export to China while ensuring efficient transport. This approach created a cycle of mutual dependency, African growth tied to Chinese demand. Infrastructure, finance, and trade were seamlessly linked. China's investments weren't just about profit, they were about power. The new railways and ports are the backbone of a China-centered trade ecosystem. Africa's economic future is now deeply intertwined with Beijing's ambitions. The shift is structural and likely permanent. The numbers come alive on the ground. In Kenya, textile factories once supplied American brands, thanks to AGOA. When U.S. tariffs hit, orders vanished overnight. China's investments in the Lamu Special Economic Zone offered a lifeline. Factories retooled for Chinese buyers, keeping workers employed. In Nigeria, hopes of selling lithium to the U.S. electric vehicle market were dashed by new tariffs. China stepped in, funding a state-of-the-art lithium processing plant in Lagos. Now, Nigerian lithium is refined for China's battery giants, locking Africa into a China-centric supply chain. The logistics have changed. Minerals once shipped directly to the U.S. now travel by rail to African ports, then to China for refining. The most profitable stage, value-added processing, now happens in China, not Africa or the U.S. Even when finished products reach America, the profits and control flow through Beijing. U.S. tariffs meant to protect American interests have outsourced critical supply chains to China. Africa's role in the value chain has shifted, often to its own disadvantage. The U.S. and China have taken radically different approaches in Africa. The U.S. Development Finance Corporation, DFC, allocated $2.1 billion for Africa in 2024, but only $650 million reached the signing stage. Tariffs made many projects unviable. American development finance was undercut by its own trade policy. China, meanwhile, integrates trade, finance, and infrastructure in a top-down, state-driven strategy. Chinese loans come with conditions. Use Chinese companies and equipment, ensuring money flows back to China. Projects like railways and industrial parks are designed to extract African resources and create new markets for Chinese goods. The American model, reliant on private investment and free market principles, struggles when tariffs create uncertainty. Policy incoherence has left a vacuum China is eager to fill, with concrete steel and billions in loans. U.S. aid programs have also been cut, further weakening American influence. China presents itself as a partner for win-win development, delivering visible results. For many African leaders, China's rapid, large-scale infrastructure is hard to refuse. The risks, like debt dependency, are real, but the alternatives from the West are shrinking. The contrast couldn't be clearer. African nations aren't just bystanders, they're charting their own course. In July 2025, leaders from 28 countries signed a declaration to diversify trade and accelerate investment in the China-Eurasia corridor if U.S. tariffs persisted. Recognizing the risks of debt, African institutions created a $2.5 billion loan guarantee fund to buffer against potential debt traps from China's Belt and Road projects. This twin strategy, diversifying trade and building financial safeguards, shows new strategic maturity. African leaders aim to harness Chinese investment for infrastructure and industry while protecting economic sovereignty. The goal benefit from Chinese capital without falling into dependency. Ambitious targets are set, like raising Africa's share of global apparel exports from 2.2% to 3.5% by decade's end. Before, this growth was aimed at the U.S. market. Now, it's routed through China-centric channels. African nations are adapting, leveraging new partnerships to build an industrial base for a global market. The continent is forging a path that serves its own interests, not just those of global superpowers. The balance is delicate, but the strategy is clear. Africa is no longer just a prize in great power competition, it's an active player. The U.S. tariffs have produced a deeply ironic result. America is now more dependent on China for critical minerals. Cobalt and rare earths, vital for batteries and defense, are now routed through China, not directly from Africa. U.S. tariffs on processed cobalt made it too expensive for American companies to buy directly from Africa. Instead, raw cobalt is shipped to China, refined, and then sold globally, including back to the U.S. The same pattern holds for rare earths from Guinea, now processed in China, and used in everything from wind turbines to fighter jets. The U.S. aimed to secure its supply chains, but tariffs handed control to Beijing. The value-added stage, and the leverage, now sits with China. In a crisis, China could restrict exports, disrupting key American industries. Years of effort to diversify supply chains have been undermined. Instead of building direct partnerships with Africa, the U.S. has pushed the continent further into China's orbit. The result, a strategic vulnerability for America, and a missed opportunity for Africa. The policy backfired, spectacularly. U.S. tariffs on African goods triggered a chain reaction that's reshaping the world. What began as protectionism has become a strategic own goal for Washington. By closing its market, the U.S. damaged decades of goodwill and opened the door for China. The surge in China-Africa trade and investment marks a lasting shift in global power. Africa is leveraging Chinese capital to build infrastructure and industry, but dependency risks remain. African leaders are showing new sophistication, building financial safeguards to manage debt. For the U.S., influence is waning. Commercial ties and soft power are eroding. With elections looming, a policy reversal seems unlikely. China's position in Africa is consolidating, with new trade and infrastructure networks becoming the default. The U.S. risks being sidelined, its promises overshadowed by China's concrete results. The story of U.S. tariffs is a cautionary tale about unintended consequences in great power competition. Africa stands at the heart of this transformation, no longer a bystander but a central player. The world has changed and Africa is leading the way. Thanks for watching a video and subscribe the channel now. Thanks.